This is not strength, it's stimulation. The US economy looks calm, markets recovered, jobs appear stable, prices feel manageable, but this calm is chemical. What you're watching is a sugar coma economy, borrowed energy, temporary relief, debt masquerading as growth, like a glucose spike, fast energy, no nutrition, tax cuts push demand forward, tariffs reshuffle costs, institutions are pressured to comply. It feels good. Briefly, the story being sold is success. The structure underneath is fragility, because prosperity built on deferral doesn't eliminate consequences. It stacks them. If something feels unstable beneath the optimism, that instinct is accurate. Stay with me, because what looks like momentum is actually a countdown. This isn't the outcome, it's the setup. And before we talk about where this ends, we have to understand how this machine works. The core problem isn't growth, it's how growth is being manufactured. An economy can expand while hollowing itself out. Markets rise not because productivity surged, but because liquidity has nowhere else to go. Consumption holds not because incomes exploded, but because debt fills the gap. Policy choices drive this: permanent tax cuts, protectionist trade, deficits treated as background noise. Together they create motion without durability. This system doesn't collapse immediately. It stretches, it absorbs pressure, it reallocates pain, but every stretch thins the material. Buffers shrink, flexibility disappears. Risk concentrates. That's the danger. Not recession tomorrow, but imbalance today, because once imbalance becomes normal, alarms stop sounding. And when alarms stop, systems drift quietly into fragility. To see why this pattern keeps repeating, we have to step back. This didn't start recently. It was built over time. For decades, slowdowns were answered the same way. Easier money, lower rates, more stimulus. After 2008, this response became permanent. Crisis management turned into economic design. Liquidity flooded markets. Assets were protected. Risk was socialized. It worked until it became the baseline. Debt grew faster than output. Financial markets detached from wages. Each cycle required more intervention than the last. Then came the pandemic. Trillions injected, demand stabilized, but the cost structure warped. Supply chains stretched thin, labor tightened, margins for error collapsed. Instead of resetting, the system doubled down. Tax cuts without offsets, trade barriers without insulation, deficits framed as harmless. This is how fragility accumulates. Not through collapse, but through normalization. Each fix solves yesterday by weakening tomorrow. And then one decision matters more than all the rest. Because the next phase didn't arrive slowly. It arrived with a date. April 2nd, 2025. It was called Liberation Day. Within 48 hours, trillions in market value vanished. Not panic, repricing. A blanket tariff reshaped costs overnight. Imports taxed broadly. China hit hardest. Supply chains recalculated instantly. The logic was symbolic. The impact was mechanical. Tariffs don't punish flags, they tax systems. Importers absorbed the first shock. Consumers absorbed the rest. Prices rose, volumes fell, revenue promises shrank, markets rebounded. They always do at first. But volatility leaves damage on planning, on trust, on credibility. Liberation Day exposed something deeper, a willingness to gamble stability for optics. And when that gamble repeats, the cost isn't the crash, it's the erosion of leverage once the threat stops working. Shock was the strategy. This is the modern version of madman theory. Chaos is leverage. Uncertainty is pressure. At first it worked. Corporations rushed to hedge risk. Factories announced. Capital committed, not because conditions improved, because unpredictability became intolerable. Then the pattern set in. Threat, market reaction, pause. Each cycle taught the same lesson. Domestic pressure would force retreat. Once counterparts learned that, leverage inverted. Retaliation became rational. Pain became mutual. Meanwhile, fiscal policy locked in imbalance. Tax cuts made permanent. Exemptions expanded. Deficits normalized. Debt filled the gap quietly. This wasn't investment. It was consumption pulled forward. And once deficits become structural, they stop being optional. Short-term growth feels like progress. That's the illusion. Because stimulus without reform doesn't strengthen a system. It sedates it, and sedation always wears off. When it does, pressure moves to institutions. Institutions only matter when they're allowed to function. The first to feel pressure is always the central bank. Independence anchors trust, not growth, trust. But that anchor weakens under political demand. Rate cuts demanded, inflation ignored, compliance rewarded, fiscal policy pushes prices up, tariffs raise costs, labor supply tightens. At the same time, monetary policy is pressured to ease. This creates a bind. Inflation rises. Credibility absorbs the strain. Markets notice. Once expectations on anchor, they don't drift back easily. And pressure doesn't stop at policy. It flows downward. Labor supply shrinks, costs rise, wages follow, but not because productivity improved. Because scarcity forced it, prices adjust faster than pay. Purchasing power erodes. If this feels personal, it is. If this analysis helps you see why pressure keeps rising, share it, because understanding the structure is the first defense you have, and what you're experiencing isn't isolated. It's systemic. The pain isn't evenly distributed. It never is. What emerges is a K-shaped economy. At the top, spending accelerates. Assets rise, options expand. Below, everything tightens. Most growth now comes from the wealthy. GDP measures activity, not well-being. When reports say the consumer is resilient, they're describing the top. The rest become invisible in averages. Three economies coexist. Those falling behind, those barely holding on, and those pulling away. Asset ownership explains why. When prices inflate, owners benefit automatically. Tax cuts raise profits. Profits fund buybacks. Buybacks lift prices. The loop closes at the top. Wages don't participate. Mobility stalls. Growth appears strong. Lives feel constrained. This isn't a flaw. It's the mechanism. And money itself accelerates it. Because who receives it first matters more than how much exists. Money never enters evenly. Those closest to issuance move first. Assets are bought early. Prices adjust later. By the time wages respond, inflation has already arrived. Purchasing power thins. This pattern compounds. Technology sharpens it. Algorithms set prices. Housing costs rise without negotiation. Scarcity becomes automated. At the same time, the middle class locks itself in place. Low mortgage rates become anchors. Mobility collapses. Inventory dries up. Households look solvent. They feel immobile. When costs rise but movement stops, fragility hardens. Looking ahead, there are only three paths: a disciplined soft landing, unlikely; a long-managed decline, most probable; or a hard correction when debt, rates, and inequality collide. The closer we get to 2026, the fewer degrees of freedom remain. Time is being treated as policy. It isn't. What matters now isn't prediction. It's awareness. Systems don't fail when no one knows. They fail when everyone knows and nothing changes. This economy isn't broken, it's exhausted. Exhausted from borrowing growth, from rewarding optics, from draining buffers. The danger ahead isn't one decision. It's convergence, debt, inequality, institutional strain. When the sugar high fades, the question won't be who was right, it will be who was prepared. If this framework helped you see the system more clearly, don't let it end here. Share it. Question comforting narratives. Stay curious. because the next phase of this story won't be decided by headlines. It will be decided by understanding how the machine actually works. And if you want the next breakdown, stay with me. The system isn't done revealing itself yet.